6 months ago, I was watching the S&P 500 push toward fresh record highs, and I couldn't stop thinking, this momentum feels eerily familiar. The intense excitement surrounding artificial intelligence, the incredibly narrow market leadership, and valuations that have stretched to extraordinary levels. Everywhere I looked, financial media was celebrating what many called a new investing era. But history has a painful way of reminding investors that markets eventually return to reality. Today, I'm sharing a clear, balanced, and data-driven analysis of why the S&P 500 faces a meaningful risk of a significant correction or even a sharp market crash before 2027. We'll also explore the critical risks that many mainstream experts and overly bullish commentators simply aren't emphasizing enough to everyday investors. Now, let me be absolutely clear. This is not fear-mongering. I'm not telling you to panic or sell everything tomorrow. That would be reckless. And historically, it's usually the wrong decision. But completely ignoring today's warning signs can be just as dangerous, because that's often how long-term portfolios suffer lasting damage. As of late June 2026, the S&P 500 has been trading roughly between 7,365 and 7,500, after recently touching highs near 7,620. And when we carefully examine today's market data, several important warning signs begin to emerge. One of the biggest is valuation. The Shiller CAPE ratio currently sits between 39 and 41, levels that history has only witnessed near the 1929 stock market peak and the 2000 dot-com bubble. If you have meaningful exposure to the stock market, whether through index funds, a retirement account, or individual stocks, this video will give you a practical framework to better understand the downside risks, the possible timeline, and most importantly, the practical steps you can take today without making emotional decisions. So, let's begin by taking an honest look at exactly where the market stands today. The valuation picture most analysts downplay. Let's begin with what I believe is one of the most overlooked risks in today's market: valuation. More specifically, the Shiller CAPE ratio. Now, if you're not familiar with it, the CAPE ratio, or cyclically adjusted price-to-earnings ratio, looks at the market differently than a normal P/E ratio. Instead of using just 1 year's earnings, it averages 10 years of inflation-adjusted earnings, helping smooth out temporary economic booms and recessions. In my opinion, that's what makes it one of the most useful long-term valuation tools available. Today, that ratio sits above 39. And honestly, that should get every investor's attention, because throughout more than 100 years of market history, we've only seen valuations reach these levels a handful of times, most notably before the 1929 crash and during the 2000 dot-com bubble. Now, does that automatically mean a crash is coming tomorrow? Absolutely not. Markets can remain expensive far longer than many investors expect. History has proven that repeatedly. But history also tells us something equally important. When valuations become this stretched, future returns tend to become significantly lower, and downside risk rises dramatically. Research covering more than a century of market history shows that when the CAPE ratio has climbed above 37, average returns over the following 1, 2, and 3 years have frequently been disappointing. In many cases, investors experienced substantial drawdowns. Again, we're not trying to predict the exact day or even the exact year when the market could correct. Nobody can do that consistently. But what we can do is recognize when probabilities begin shifting. And right now, the probability of seeing a 20%, 30%, or even 40% correction appears materially higher than normal. And valuation isn't the only concern. Market concentration is adding even more risk. Over the past year, a very small group of mega-cap AI companies has generated the overwhelming majority of the S&P 500's gains. When only a handful of companies are carrying an entire index, the market becomes increasingly fragile. If just 1 or 2 of those leaders disappoint investors, the impact can spread surprisingly fast. That's exactly what happened during the dot-com bubble. A small number of technology companies drove most of the gains, until investor expectations finally collided with reality. Even the correction we experienced in 2022 occurred at lower valuations than we're seeing today. Some independent research firms, including Trefis, have suggested that if valuations eventually move back toward long-term historical averages, the S&P 500 could face downside of 25 to 50%. Now, I'm not saying that outcome is guaranteed. Far from it. But I do believe it's a scenario investors should seriously consider, instead of simply assuming the market will continue climbing forever. Because one of the biggest mistakes investors make is confusing a strong recent trend with a permanent reality. Markets move in cycles. They always have. And eventually, every period of excessive optimism is followed by a return to more reasonable expectations. Risk number 1, the AI investment cycle. Innovation versus bubble dynamics. Let's talk about perhaps the biggest story driving today's market: artificial intelligence. Now, I want to be very clear. Artificial intelligence is real. It's not just another passing trend. It's one of the most important technological breakthroughs we've seen in decades. I genuinely believe AI has the potential to transform industries, increase productivity, and create trillions of dollars in economic value over the coming years. No serious analyst is questioning that. But here's the problem. A revolutionary technology doesn't automatically justify any price investors are willing to pay. And that's where I believe many investors are becoming overly optimistic. Today, some of the world's largest technology companies, including Microsoft, Amazon, Meta, and Google, are projected to spend hundreds of billions of dollars throughout 2026, building data centers, purchasing advanced AI chips, expanding cloud infrastructure, and securing enough electricity to power the next generation of artificial intelligence. These investments are enormous. In fact, they're now contributing meaningfully to overall U.S. economic growth. But here's the question that I keep asking myself. Will these massive investments generate enough profits to justify today's valuations? Because right now, although AI adoption continues accelerating, the broader economy hasn't yet experienced the dramatic productivity gains many investors expected. Businesses are experimenting. Consumers are excited. But monetizing AI on a large scale may take longer than today's market seems to believe. Several respected research firms, including Capital Economics, have suggested that the AI rally may be entering its later stages. In fact, some analysts believe we could still experience one final explosive rally before investors begin reassessing expectations sometime during 2027. And if that happens, investor psychology can change remarkably fast. Imagine companies spend hundreds of billions, yet earnings growth fails to keep pace. Or perhaps too much infrastructure gets built, creating excess capacity. Suddenly, the market begins asking a very different question. Not, how much bigger can AI become? But instead, did we simply pay too much, too soon? That's exactly how bubbles begin to unwind. If leading AI companies experience corrections of 20, 30, or even 40%, the broader S&P 500 would almost certainly feel the impact. Why? Because these companies now represent such a large percentage of the entire index. History offers an important reminder. During the dot-com bubble, the internet itself was absolutely revolutionary. That wasn't the mistake. The mistake was believing that every company would justify extraordinary valuations. Many didn't. Technology changed the world, but investors still lost enormous amounts of money because expectations had moved far beyond reality. Even respected investors, like Michael Burry, have drawn comparisons between today's AI enthusiasm and previous periods of excessive market optimism. Now, that doesn't mean history will repeat itself exactly. Markets never move in precisely the same way, but they often rhyme. And today, the concentration risk appears impossible to ignore. If the market's biggest winners stumble, the entire index could move sharply lower. Risk number 2, macroeconomic and policy headwinds. Now let's move away from technology and look at the broader economy. Because beneath the strong market performance, several economic risks continue building. The first is the American consumer. Throughout the pandemic, consumers accumulated large amounts of savings. That spending helped support economic growth. But today, much of those excess savings have already been spent. At the same time, credit card debt has climbed to historically elevated levels. And that's important because consumer spending represents roughly 70% of the U.S. economy. If consumers begin spending less, businesses generate less revenue, corporate earnings weaken, investor confidence falls, and stock prices usually follow. Another major uncertainty is inflation. Although inflation has moderated compared with previous years, it hasn't disappeared. Energy prices remain unpredictable. Oil prices could rise unexpectedly because of geopolitical tensions or supply disruptions. If energy becomes significantly more expensive, consumers pay more, businesses pay more, transportation costs increase, manufacturing costs increase, and inflation can quickly become a problem once again. That creates an extremely difficult situation for the Federal Reserve. If the Fed cuts interest rates too aggressively, inflation could return. But if rates remain elevated for too long, economic growth could slow considerably. Neither outcome is particularly supportive for today's expensive stock market. Another factor receiving more attention is recession risk. Depending on the forecasting model, several economists estimate a recession probability between 30 and 40% during the 2026 to 2027 period. Now, no model can predict recessions perfectly, but these probabilities shouldn't be ignored, especially when combined with elevated valuations and slowing economic indicators. There's also America's growing national debt. Annual interest payments have now exceeded $1 trillion. That's a remarkable number. Higher debt limits future policy flexibility and increases pressure on government finances. Meanwhile, many institutional investors appear noticeably more cautious than retail investors. Historically, when professional investors become defensive, while retail enthusiasm remains high, periods of increased volatility often follow. Again, none of these factors guarantee a market crash, but together, they create a much more fragile environment than many investors realize. Risk number 3, fragilities in sentiment and market structure. Now, let's talk about something that doesn't receive nearly enough attention: investor psychology. Because markets are driven by two powerful forces, fundamentals and human emotions. Right now, investor sentiment remains remarkably optimistic. Many traders believe artificial intelligence will continue driving markets higher and higher. And while that could certainly happen, extreme optimism has historically created its own risks. One concern is the growing popularity of crowded trades. Large amounts of money continue flowing into the same group of momentum-driven, mega-cap technology stocks. When too many investors own the exact same companies, the market becomes increasingly vulnerable. Because if sentiment changes, everyone rushes toward the exit. At the same time, that's exactly why strategists at J.P. Morgan have warned about the possibility of a sharp correction driven by positioning rather than fundamentals alone. Another issue is earnings expectations. Analysts currently expect strong double-digit earnings growth across many sectors, but markets don't simply react to whether companies grow. They react to whether companies grow enough to justify expectations. If AI adoption slows, even slightly, if corporate margins come under pressure, or if the broader economy weakens unexpectedly, investors could quickly reprice valuations. And that's how multiple compression begins. Major institutions, including Bank of America and Goldman Sachs, have highlighted several warning signs that resemble conditions seen before previous periods of elevated volatility. These aren't extreme predictions. They're thoughtful observations based on historical data, market positioning, and valuation analysis. Yet despite these warnings, the dominant narrative across financial media remains overwhelmingly bullish. And that's exactly why caution becomes important, because markets rarely make investing easy for the majority. Now, to remain balanced, let's also consider the bullish argument. Corporate earnings have remained surprisingly resilient. Artificial intelligence continues expanding rapidly. American businesses have consistently demonstrated remarkable adaptability, and over the long term, innovation, productivity, and economic growth have rewarded patient investors. Those are powerful arguments, and they deserve respect. But here's what concerns me. Entering 2027, with valuations still sitting near today's historic extremes, without any meaningful correction, would be highly unusual. From a historical perspective, investors who purchase stocks near previous CAPE peaks often experienced years of below-average returns. However, those who remained disciplined, continued investing, and deployed capital during market declines eventually came out ahead. History reminds us that corrections, while uncomfortable, often create the best long-term opportunities. Now, let's move away from the risks, because identifying problems without offering solutions doesn't help anyone. So here's the highest value part of today's discussion. 5 practical actions you can consider right now. Number 1. Stay disciplined with dollar-cost averaging. Instead of trying to predict the exact market top or the exact bottom, continue investing a fixed amount on a regular schedule. This strategy, known as dollar-cost averaging, has helped many investors reduce emotional decision-making. No one consistently times the market perfectly, but disciplined investing over long periods has historically produced excellent results. Number 2. Build a cash or bond buffer. Consider keeping approximately 10 to 20% of your portfolio in short-term treasury securities, high-quality bonds, or cash equivalents. This serves 2 important purposes. First, it provides stability if markets become volatile. Second, it gives you cash available to purchase quality investments if prices decline significantly. Think of it as keeping dry powder ready when opportunities appear. Number 3. Manage concentration risk. Take a careful look at your portfolio. Ask yourself, how much exposure do I have to the largest mega-cap technology companies? If one sector or one group of stocks represents too much of your investments, it may be worth rebalancing. That doesn't necessarily mean selling everything. It simply means reducing unnecessary risk. You might consider increasing exposure to value stocks, dividend-paying companies, international markets, or businesses generating strong free cash flow. Diversification remains one of the most effective risk management tools available to investors. Number 4. Stress test your portfolio. This is perhaps the most important question you can ask yourself. If the S&P 500 declined 25, 30, or even 40% over the next 12 to 18 months, could you honestly hold your investments without panic selling? Be completely honest with yourself, because successful investing depends just as much on emotional discipline as financial knowledge. If your answer is no, then your portfolio may currently carry more risk than you're truly comfortable with, and it's far better to recognize that today rather than during a market panic. Number 5. Prioritize quality. Finally, focus your investments on businesses with durable competitive advantages, companies with strong balance sheets, reliable cash flow, reasonable valuations, and management teams capable of navigating difficult economic environments. Avoid chasing narrative-driven companies trading at extreme valuations without proven profitability. In my experience, quality matters, especially during uncertain markets. My personal approach. Now, people often ask me, so, what are you personally doing? Here's my honest answer. I remain invested for the long term, because history shows us repeatedly that time in the market has consistently outperformed trying to perfectly time every market cycle. However, that doesn't mean ignoring risk. Over recent months, I have gradually reduced concentration, improved diversification, and become more selective about where I'm allocating new capital. I'm not preparing for certainty. I'm preparing for possibility. Important disclaimer. Before we finish, I want to make one thing absolutely clear. Nothing discussed in this video should be considered personalized financial advice. I am not a registered financial advisor. Markets are inherently uncertain. Past performance does not guarantee future results. Please always perform your own research or consult a qualified financial professional before making investment decisions. If the S&P 500 does experience a significant correction before 2027, it will almost certainly feel uncomfortable. It always does. But history also teaches us that every major correction has eventually created new opportunities for disciplined investors. The market has recovered from every major downturn. Over the long term, innovation, corporate adaptability, and earnings growth remain powerful forces driving the American economy. The difference between average investors and exceptional investors often isn't intelligence. It's preparation, it's patience, and it's emotional control. Respect the upside potential, but never ignore the downside risks. If today's analysis helped you see the market from a different perspective, I'd love to hear your thoughts. Which concern worries you the most? Valuations, artificial intelligence, or the broader economy? Leave your opinion in the comments below. I genuinely read every single comment, and I always enjoy learning from different perspectives. If you enjoy balanced, research-driven, no-hype investing content, please consider liking the video, subscribing to the channel, and turning on notifications so you don't miss future market updates. Thank you for watching.